Hello, folks. Welcome to our third episode of the Energy Trends podcast from Grid Beyond. We're so excited today to welcome Anna Mayzenberg, who's the lead of market operations and design at Key Capture Energy. Key Capture has over 600 megawatts of operational BESS in the country and over 10 gigawatts in development. And we're really excited to talk with Anna today about the market trials going on in terms of ERCOT's real-time co-optimization plus batteries going on currently in the month of November 2025 and set to launch in early December. So really timely conversation, something that both of our teams are working on to get ready for the most significant market enhancement to the real-time nodal market since its inception back in 2010. Anna, thanks for the opportunity to talk with you today, and really excited to hear what you're doing around RTC+B and batteries and ERCOT and beyond.
Yeah, absolutely. Thank you so much for the opportunity. I'm excited to talk about this huge transformation that's coming down the line for us. Alden, I know you'd asked me before this to talk a little bit about my personal journey into battery storage and market operations. Frankly, I wanted to start with the fact that I grew up in Houston, Texas. So probably half the reason that I'm here in this field is because I was destined for it. But in all seriousness, I went to school for management information systems and a little bit of politics. And I did my senior thesis on the American Clean Energy and Security Act, which is essentially a proposal for carbon markets in the US, or it was back in the day. So that's kind of what got me really interested in market design, and with a background in that and coding, battery dispatch optimization was a perfect fit. So I joined the Key Capture team back in 2022, and we are a developer, owner, and operator. We've been around since about 2016, and we were acquired by SK ENS in 2021, I believe, which has been a really great partnership. And it's been a great place to sort of hone my market operations skills. We've got over 500 megawatts in ERCOT, as well as sort of a development fleet across the US. So there's plenty of room to play around with different strategies across our fleet. And real-time co-optimization is no different. So we've really enjoyed preparing for this exciting new challenge and opportunity and participating in those ongoing market trials.
Yeah. And our team is too. I think you characterizing it as both an opportunity and the challenge is really salient. Just for some context on RTC plus B, most other deregulated markets in the US already procure ancillary services in the real time as well as in the day ahead. ERCOT was, to my knowledge, sort of the last market to do a real time buy of ancillary services. And that can be really helpful for batteries because you have greater visibility into your state of charge for the real time hour ahead interval, say, than trying to project state of charge out 24, 36 hours in advance when you have to procure them in the day ahead. And so this RTC plus B is enabling that simultaneous co-optimization of energy alongside ancillary services in the SCED model, which runs every 5 minutes. And so having this sort of single energy storage resource representation instead of what they're doing, up till now, which is both a generator and a load, should simplify things, I think, for a lot of battery operators. And, we're seeing other reforms in terms of replacements for RRDC, moving towards product-specific pricing as well. And I know you mentioned over 500 megawatts active in ERCOT right now. Curious, how this has impacted your thinking around, duration requirements when you're planning, and then what you're looking at in terms of those ancillary services stacks that you're bidding into.
Yeah, absolutely. I mean, it definitely has impacted us in numerous different ways. I would say the biggest thing is we have to, or maybe the most exciting thing is that we have to worry less about finding coverage for our day ahead obligations, which is a pretty big time sink if you do end up short. But it does mean a whole overhaul of our system. So we've been kind of staying in touch with RTCP news for the past year or so and following kind of each regulatory conversation around how the duration requirements will change, and throwing in our 2 cents as well, and kind of working very closely with our asset ops teams to not only meet those requirements of the duration requirements as well as the new I know you had mentioned the base point deviation charge requirements changing, to meet those as well, and to also determine kind of what opportunity cost looks like for each ancillary service under this new schema, and how to set up a quick running model with so many new decision variables. There's just a lot to consider.
Definitely, and especially for, like, different asset types, there's obviously RTC plus batteries, so I think batteries are really the focus here. But how does it change if you're thinking about this for, like, a one-hour duration battery, like we saw a lot of come online in ERCOT, in the past decade, say, versus the two-hour batteries, which are more commonly coming online in the past few years, versus the four-hour batteries, which we know are sort of under consideration by developers as well. Does it affect those battery durations differently?
Right, definitely. Yeah. So for duration requirements, I would say it's a pretty tricky problem. So I think what it really comes down to is the big change that's happening in RTC plus B with duration requirements is prior to RTC plus B. Duration requirements limited what a resource could sell in the day ahead, but in the real time, what we had was essentially NPR 1186, which prevented a battery from dispatching if it had less than 1 hour of SOC in the tank for the ancillary services it was carrying, with that hour being like discounted as you go through the hour. What's important to note there is that that was a 1 hour requirement regardless of what the ancillary service was. So if you were carrying non-spin, it was still a 1 hour requirement, not a 4 hour requirement, and it only prevented you from dispatching, not from carrying the service. So under RTC plus B, what's changing is that duration requirements, some of them are technically lowering, with ECRS moving from 2 hours to 1 hour, and RRS and regulation moving to 30 minutes instead of 1 hour. But that doesn't necessarily mean that these markets will be overrun with new battery capacity, because in real time, ERCOT has added a requirement that will not allow a battery to clear the ancillary service at all unless it has that full duration requirement available, that state of charge to meet it, which is a fundamental shift. And so that could create ancillary scarcity in times that it did not exist before. And it's more likely to create scarcity for those 1 hour or 2 hour units, as opposed to a 4 hour unit that might be able to carry ancillaries for more of the day, and still be able to dispatch into those kind of shorter 1 to 2 hour peaks.
Definitely. And, I think the weird thing about this as that sort of trade-off we talked about at the top, right? There's maybe more flexibility to qualify in terms of, the duration requirements are no longer there in the bid, but you knew how now have new constraints to manage in terms of state of charge around those duration requirements and how often your battery can actually dispatch into those ancillary services.
Right, exactly. Definitely.
And when we were talking about this, a few days ago, you brought up congestion as a really salient point here. I think you said that there's over $1 billion in annual wholesale market savings. Where do you think congestion plays into that figure around how much savings RTC plus B is slated to generate?
Yeah, definitely. So, I mean, I think there's obviously several different things that are going to contribute to those savings. I think congestion is one major component, and I'll talk about another one as well. But generally, our expectation is that RTC plus B will decrease congestion across the grid, given the flexibility that comes with it. So, now that's not to say that congestion won't arise as we see market fundamentals change. Obviously, we're heading towards a lot of load growth, and the generation resource mix is continuing to change. But this system will certainly be more efficient at managing it. So let me kind of give you a scenario. Today, if we imagine some unexpected congestion arises in North Texas. So conditions in the state are otherwise quite mild. So let's say that the system lambda is around $30. Today, you can expect at least some of the units there in North Texas to be tied up in their day ahead obligation. So let's say that 500 megawatts of RRS were procured in that congested region as of the day ahead. That RRS is very unlikely to be deployed under these conditions because those megawatts and megawatt hours are tied up and unable to be dispatched, leading to sort of an artificial congestion, one might say, and a significant price spike in that area in order to get the needed energy imported from somewhere else in the grid, if that makes sense. So under RTC plus B, those ancillary obligations don't need to be procured in like a congested area. So they wouldn't need to be procured in North Texas in this case. And the reasoning behind that is, since ancillary service pricing is system wide, but energy is locational, what will happen instead is these energy prices will come up in that region, like at those congested nodes. And so the resources there will clear to dispatch, and the ancillary services will be instead systematically procured in other parts of the state where generation is not needed as much. And so we will still expect to see some like minor spikes in those congested areas in order to procure the right amount of generation. But because we can get it in the most efficient location, that spike will not be as pronounced. So definitely something to keep in mind for operators who have previously relied on congestion as like a large portion of their revenues. Yeah.
Definitely. And Grid Beyond manages batteries in ERCOT as well as other markets. As I mentioned, ERCOT's sort of one of the last RTOs in the US at least to deploy this real-time, version of the ancillary services product. And what we've seen from other markets is that there's really a period of adjustment around any significant market change. We don't expect this one to be any different. So we're looking at sort of December 5th as, a time of really high scrutiny for us in the first few weeks, after that, as the program launches in earnest in ERCOT. And we are advising our battery asset owners that we work with. So, really have a sort of team ready to deal with things that may come up, whether that's an outsourced team like Grid Beyond, someone, internal like you at Key Capture, Anna. But just having that sort of uh, looking out for the opportunity as well as the potential challenges that'll arise around this. For instance, in Japan, we saw a new ancillary service market launched last year where for a, a week they were printing ancillary services at $1 million a megawatt hour or megawatt year for
Wow.
me. Yeah. And so that only lasted for a week or two, right? Until the generators and that's catch up to the new market paradigm. But we saw something very similar in PJM just last month as they moved their regulation signal from a bifurcated A and D signal into a unified regulation signal. Similarly, just takes a little bit of time for the larger market to catch up, and so for sort of quickly adaptive companies, there is a real opportunity to make upside revenue during those periods of change as well. So something that we're looking out for. And anything else, Anna, that you're looking out for sort of as RTC goes live, or any like advice for listeners who might have assets in ERCOT as they look at RTC+B in early December?
Yeah, absolutely. I mean, I would definitely keep a close eye on sort of how market trials have played out. ERCOT is reporting, I'm not sure if they did this week, but they are reporting weekly on how revenues are playing, or not revenues, but how pricing is playing out for both energy and ancillaries and how congestion runs have been coming in. Obviously, we can take those with a grain of salt because we don't know for certain that people will operate the same way during trials as they will day one. But definitely interesting to see and a clue as to what operators might be thinking. I would also take a close look at your own opportunity costs for ancillaries and energy and think very closely about what those should be. It's going to be different for each individual operator, but certainly something worth thinking about. Yeah.
Um, And it's great to hear about some of the insights that came around from ECRS, from other sort of market changes that introduced that volatility. I mean, ECRS summer of 2023, that was a great summer for everyone, I think, right? In 2024, 2025, we've seen much lower revenues, right? So battery revenues dropped, I think it's 71% year over year from 2023 to 2024. Real time prices similarly came down a lot, over 50% in some instances. And a lot of that, I think, is related to the amount of storage that came online, right? So there was almost 10 gigawatts of new solar and or storage added, and the peak loads to date have remained flat. I'm curious how all of this has played out for KCE's portfolio. What sort of real-time operational impacts have you seen? How have you been making strategic adjustments to the new sort of ancillary services saturated ERCOT reality?
Absolutely. Well, for one, I would like to note that while revenue losses are no operator's favorite thing to see, it is incredible to see how solar and storage have both been able to meet demand in ERCOT, and decrease volatility like this. With AI and other data centers on the horizon, even in the next 5 years or so, as large loads, we are really excited to see the role the batteries can continue to play, as we go forward in a very constantly evolving market. To answer your question, though, it certainly required us, like all other battery operators, to become a little quicker on our toes, right? So Key Capture has a very agile team, and performing well in the markets is very important to us. So through our backcasting systems, we are able to catch when our strategies may not be performing as well as the market shifts. So our percentage of sort of omniscient will improve and decrease as the market changes. So We certainly had to come up with new approaches and ask ourselves more questions, day to day about where to place our bets in terms of real time versus day ahead. But it is definitely a constantly evolving playing field.
And how do you think this changes, if at all, with RTC plus B? Do you think this makes saturation worse? Does it make it better? And so what do you think that means for the, next couple of years of battery revenues in ERCOT?
Sure. I mean, when we talked about duration requirements, I think my sense is that it could go either way for ancillary services in particular. Like there are signs that point towards a little bit more saturation, and there are signs that point in some instances to less. And truly, what's gonna be most important is how much saturation we see around the ramp periods, more so than how much saturation we see in the middle of the day or the middle of the night. So, it's really gonna be interesting to see how things play out sort of in that morning and evening ramp window, but not clear either way on a final better or worse.
Definitely. And any advice you'd have for folks that are managing that sort of real time view of things as we approach December 5th?
I don't think there's advice that you can give for, that's gonna apply to every single day, right? Like, certain days, it's gonna be better for you to hold out until the very end of a ramp so that, like, nobody else is available and you're the only one there to meet very high demands. Other days, it's gonna be best to discharge an hour, like, or what seems like an hour, earlier than the peak. So it's just, improving your forecasts and making sure that you're doing everything that you can.
Definitely. And getting, I think, as close to that as you called it, percentage of omniscience. I thought that was great. Like we usually say percentage of perfect foresight. And I think percentage of omniscience, is just a interesting way to think about if you had all the right information at your fingertips, how well could you do?
Yeah, exactly. I can't take credit for that name. That's my colleague. But
Well, it's a good one. We'll hope we see it in more discussions in the future. And I guess maybe if we pivot to the trial experience, right? You mentioned you're in these market trials right now, getting ready for RTC plus B. They started with connectivity testing back in May and June, and then moved to like real time execution tests over the summer. Now we're in the closed loop test stage, and I think we're really close, to the go live. We're looking at it in about 2 weeks from when we're recording this. So I'm curious, what are you actually seeing in the trials right now?
yeah, absolutely. I think what we've seen has been really quite interesting. Obviously, like I mentioned before, you got to take it all with a grain of salt. But what we've kind of heard consistently in market trials is that the pricing isn't necessarily realistic due to folks' offers being particularly high or maybe even inaccurate in a way that may not carry over into go live. But for instance, earlier in market trials, for example, I believe it was August 19th, you could see proxy offers very clearly setting ECRS price for several hours of the testing window. I believe the testing window is only about like 7-ish hours, and this was for at least 3 of them. And RRS proxy offers were setting price as high as $700 in 1 hour simply due to a lack of sufficient offers, from resources. And as time has gone on, and ERCOT has obviously worked very hard to call all of these companies and sort of ask about their telemetry and their offers, um, things have definitely improved. And as you kind of review the results of market trials in the following months and weeks, proxy offers are much less likely to set price in recent testing dates. So that gives us a lot of promise for day one. However, there are still sort of energy spikes that are unexpected, I would say. Um, so if you look closer at October 22nd, which I think as of this time of recording is the last date that market trials have published prices for, you can see that System Lambda jumps up about $1,800 above the pre-RTCB value around 7 p.m. So in that sort of evening ramp. And when you take a look at the proportions of resources offering at different, prices pre and post RTCB, there's like a very drastic difference and a clear cause. So far more megawatts, I think eyeballing it, I would say about 5 gigs, are offering energy at offer cap as opposed to anywhere between 0 and offer cap. And so that's very obviously what's leading to that scarcity. So whether that trend is set to continue or if that's like a temporary artifact of market trials, only time will tell. But what I would really recommend for operators is just ensure that you're thinking about these things and keeping an eye out on price day one in case this is a trend that continues, could see some exciting volatility.
Definitely, and that volatility, I think, will be sort of an opportunity. There's obviously going to be maybe arbitrage opportunities from folks putting in offers only at the cap or the floor, if you're have a more sophisticated or sort of nuanced pricing view. Are there other opportunities that you see or sort of like common failure patterns that you're worried about?
I think in terms of opportunities that I see, I think it's really just primarily looking out for that volatility and also ensuring that you are ready to shift at a moment's notice. So, like, if you see the day ahead is coming in very high and real time is coming in very low, obviously, like, you need to be really prepared to manage that situation, or vice versa. If you started committing in the day ahead and you end up seeing the spread in the opposite direction, being really ready to shift and sort of online and available for that the first few weeks.
Definitely. And I think you just started to talk or touch on some of the risk management, sort of like strategic bidding considerations around the new era that we're leading into. I think one, that we're tracking, right, is just having more frequent settlement intervals means that there's more to manage, right? There's more points of exposure from a risk perspective. Um, we also talked a little bit before about sort of like set point deviation, and how that's going to impact, the sort of new paradigm, as well as like what the reliability unit commitment or rock capacity short charges penalties will look like. How are you thinking about like deviation from set point for your assets? And then, what are you doing around rock? How are you managing those capacity short charge penalties?
Yeah, absolutely. So, in terms of our real time and operational risks, we are setting up systems that notify us when we see unexpected behavior, as I mentioned. So, we run an optimization model that keeps in mind sort of all the basic inputs, state of charge, price forecasts, and your high sustained limit, etc. And that model very closely follows ERCOT's market structure, which I pride myself on because that is my job. But that really allows the team to only step in manually when we are needed, and for a lot of the work to be sort of offloaded onto that model, and allows us to bid every 5 minutes as well, which would be impossible as an individual. And the decision space is so large under RTC plus B, and we're really grateful to have spent years building and improving this model so that it's ready for a change like this and can help us manage some of those risks. Um, in terms of the ruck capacity short charges, so ruck capacity short charges are actually something that we have identified as a newer risk under RTC plus B. They are a charge that already currently exists. And I'm going to give a little bit of background on what they are. So and I'm gonna try to avoid getting too into the weeds as well. But essentially, in ERCOT, there's something called the reliability unit commitment, and batteries cannot be committed by the reliability unit commitment system. But these RUCs, as they're called, assume that batteries are committed according to their day ahead positions, and they expect their current operating plans to reflect that. Under RTC plus B, ERCOT also wants plan state of charge to be part of that requirement. And what that means is essentially they want your planned state of charge to move according to what you sold in the day ahead. So if you sold 50 megawatts of energy, you should be losing 50 megawatt hours in that hour. If you sold 50 megawatts of ECRS, you should be keeping an eye on what the posted RUC ancillary service deployment factor is for that hour and taking it into account to determine your required movement as well. This adds complexity because it also adds risk, right? So, depending on the size of the deployment factor, your battery might not be able to sell ancillary services around the clock in the day ahead without incurring this potential charge. Historically, I would say this charge has been small and infrequent. It's on the scale of cents per megawatt hour short. But given the potential for an increase in RUCs, because ERCOT is going to be operating conservatively at the start of RTC plus B, these changes are definitely something to watch out for and make sure that you're prepared for. So if you do want to be fully covered against these charges, I would keep an eye out.
That's really good advice. And I'd love to talk maybe next around what we've learned from other markets. Before we move on to that, any sort of final words on like what to look out for in RTC plus B around risk management, around RUCs for operators that may not be as in the weeds as y'all are at this stage?
I would keep an eye out for those kind of changing rules. So, for example, with the set point deviation, the making sure that you're in compliance with that is now it's like a 3 megawatt or 3% bound, I believe, to like ensure that you're keeping in with ERCOT's rules. So any rules that are changing like that, I would just be aware of and make sure that you're updating whatever's alerting you and your systems to make sure that you are in compliance. Other than that, I think we've covered it.
Awesome. Well, hey, good luck for all the operators looking at the December 5th change with RTC plus B. As we've talked about a little bit already, right? This is ERCOT's not the first market to introduce real-time co-optimization. CAISO's had real-time co-optimization for years, and we've seen that it has, sort of improved the congestion overall at the grid level. GridBeyond also operates in European markets like the UK, where we've seen, similar saturation, frequency response saturation back in 2019, for instance, and then the sort of the forced evolution, I think similar to what ERCOT's undergoing right now into the more wholesale, day ahead and real-time energy trading. And that's eventually sort of stabilized into, the current structure in the UK. And, we see a lot of similarities coming into the ERCOT market. We could go on. PJM, right, had their sort of regulation boom and bust cycle back in 2015 with Reg D. I know you all are actively looking at other markets outside of ERCOT. What are you seeing in terms of, translating your ERCOT experience into other markets or vice versa, translating experience from other markets back into how you operate in ERCOT?
Yeah, absolutely. So Keycapture has a few operational sites in NISO, so I can certainly speak to that. We know that ERCOT's RTC+B is set up very similarly to New York. So some of the things that we can expect to carry over are the general principles of co-optimization, right? So ancillary prices are going to move around with energy the same way that they do in ERCOT's day ahead and in New York. So when you see kind of like a very high energy peak, you'll see kind of regulation and reserves trail like very slightly behind. So that's definitely something that we're keeping an eye on, and also to continue seeing that pattern in the peaks more so than in the shoulder hours. ERCOT, of course, is unique in many ways, though. One of them being that it allows for a lot of operational flexibility that I think other markets do not. So it allows resources to update their bids in real time, as I'm sure you know. So if you as an operator see conditions change at, say, 10:17 a.m., you can reflect that in your bids for the sched interval at 10:20. That's not something that you can do in New York, and I don't think it's something you can do in most markets. And that's something that's really especially important for batteries, since their bids are quite dependent on opportunity cost, which shifts very, very quickly. So it's certainly something that the best-in-class operators are taking advantage of, and I would recommend that folks take advantage of. And of course, the resource mix and differences in the availability of like imports and exports will set ERCOT's market fundamentals apart from those markets as well. So it's difficult to say that they'll ever be one to one outside of the general principles of co-optimization.
Sure. And I know that you all are continuing to be bullish on ERCOT, sort of despite, what prices have been printing at for the last year or two. Where do you see future opportunities maybe focused in the ERCOT market? And how are, as a successful operator like KCE looking to take advantage of those in the, years ahead?
Absolutely. Yeah, we are certainly long Texas for the increasing load, and we are expanding in pretty much all markets across the country. So maybe not all of our eggs in one basket, but we certainly expect some volatility down the line, like we said, with all of that large load interconnecting.
Awesome. Well, Anna, I want to thank you so much for taking the time to talk about RTC plus B today. I think there's a lot of complexity, a lot of opportunity coming down the line in the weeks and months ahead as we move towards that. I think, we at Grid Beyond are expecting there to be a couple of weeks, maybe a month of, real volatility post implementation that we're going to be monitoring closely for us and our clients. And I think that, a lot of the factors you highlighted today around SOC management, around sort of adapting your bidding strategy and being responsive in the real time, is great advice, right? We could not have given any better to clients that we work with. So really appreciate that you sharing that perspective as well as, what's going on in the sort of medium and long term as we move from the saturation that we're seeing today into the load growth, of the future and what opportunities that allows. So Any sort of final advice you want to leave listeners with today?
Yeah, absolutely. So I'll repeat a couple and add some just so everyone's remembering it all. But definitely taking a close look at your opportunity costs for ancillaries and energy, and also ensuring that your telemetry and your bidding processes are accurate by participating in market trials is really important, and making sure that everything is flowing through correctly. You would be surprised how easy it is to have a point going somewhere that you're not expecting it to go, and that will significantly change your clears. So just making sure all of your ducks are in a row is very important as we get into these final few weeks.
Definitely. Well, Anna, thanks again for talking with me today. Really enjoyed the conversation. Really excited to see how you all are doing in the RTC plus B co-optimization paradigm of the future, and I'm sure we'll talk as the industry evolves and we see a lot of these deployments start to make real impacts on ERCOT and other energy markets around the country.
Absolutely. Thank you so much. It was great speaking with you.